Well, thank you very much for joining us today. My name is Paul Featheringale. I am the USC Region Director with the South Carolina Small Business Development Center, and we are offering a topic today that we're really excited about. This is a new one for us, something that we don't normally do, but something that is very important, something that a lot of business owners have to tackle, at some point during the life of their business, which is the idea of purchasing commercial real estate. So before we get started, I just wanted to give you a quick overview for any of you who may not have participated in any of our events before about who we are. So the South Carolina Small Business Development Center, we have 21 centers across the state. We offer individual confidential business consulting at no cost to you, the client. We have a number of highly trained consultants for both existing and startup companies. We have statewide over 50 consultants, and we have a variety of services that we can provide. We can advise on business plans, financial and operations management. We can help you find different financing options, marketing strategies, HR, and many other things. These are our locations around the state. We have 21 different offices around the state. So pretty much no matter where you are in South Carolina, there are people who can assist you. And so the services I mentioned, consulting, we also offer educational workshops like this one. We can provide referrals to other useful business resources. We also have a number of specialized services, including government contracting, exporting, technology commercialization, veterans business assistance, and minority outreach. If you're interested in further working with us, you can visit our website to find a center and make an appointment. You can also follow us on Facebook. And just to give you an idea of some of what our impact was last year, we assisted just under 600 clients, assisted in the creation of almost 3,000 new jobs, over 200 new businesses, 67.1 million in financing, and almost 55 million sales increase. So again, if you need assistance, this is our website. Please sign up to request counseling. This is my contact information. And so, basically the way we look at this with this topic with commercial real estate, you're going to find out during this session what's involved in applying for financing to purchase commercial real estate. And what we can do is then, if you need additional assistance with that, with referrals to resources, with putting financials together, with doing anything like that related to this process, we can help you with doing that. And so at this time, I want to introduce our featured speakers for today. We have a panel of really outstanding experts in this field. We have David Harper, who's with Provident Business Financial Services. We have Anthony Weston, who's with Grow Financial, a federal credit union. And we have Drew Shafetti, who's a real estate broker with Palmetto Commercial Properties. So at this point, I want to turn it over to you, David, and I'll let you take it away. And you are muted.
Yes, I was. Thank you, Paul. Appreciate that. And thank you for having us, and welcome everyone to this. Where, as Paul said, we're really excited about this. To my knowledge, I'm not aware of any commercial real estate buying webinars out there. They all seem to be focused on residential, which is important. But if for a business owner looking to buy their building, this is certainly useful information. And I've said many times to my clients, the purchase of commercial real estate is very similar to residential, but it's also very different. So I think this is a great opportunity to help put the information out there to help educate, answer questions, and get people thinking about their commercial real estate buying purchase. I'm going to go ahead and share my screen here. All right, again, my name is David Harper. I am with Provident Business Financial Services. Provident is headquartered in Columbia, but we're a statewide certified development company, or CDC. And a CDC is a not-for-profit licensed, regulated corporation by the SBA. So we're not SBA employees, but the SBA are our regulators. And we provide SBA 504 commercial real estate loans. Now, the SBA has multiple programs. I'm going to only be addressing about the 504 because that is the program that is designed specifically for commercial real estate. And again, the reason it's designed specifically is because it has the features that someone buying real estate would want to have. Well, let me touch on a little bit here, and Anthony can jump in as well, but I want to touch on the difference between a conventional loan and an SBA 504. I'm sure many business owners are familiar with the SBA or the Small Business Administration. They provide all sorts of loans, even disaster loans, as we're all aware from the pandemic with the Economic Injury Disaster Loan, or EDL, and the PPP. But this is the SBA 504 and the conventional loan. So the key difference here with a conventional loan, typically a conventional lender will lend 75 to 80% of the appraised value. So that means as a borrower, you'll have to be putting in anywhere from 20 to 25, maybe even 30% down payment. The SBA 504 does up to 90% financing, meaning your down payment is actually reduced starting at 10%. So right there is a big cost saving, certainly for someone looking or thinking about buying and trying to save up. That 10% versus 20% makes a big difference. For your terms, they are slightly different as well. With a conventional loan, typically you have a term of 5, 7, 10, or 15 years, and then that loan balloons or matures. Now, this is a key difference from the residential real estate, because we're all familiar with a 30-year fixed or a 15-year fixed. Well, in commercial, it's a little different. Your term is set at a 5, 7, 10, or 15-year term, but your amortization is set typically on 20, 25 years. Now, in plain English, what I'm saying there is you've got a term, that's the first term of the loan, and then your amortization is the life of the loan, and your payments are based on the amortized amount. So let's say you're on a 20-year amortization, you are going to be making payments if it's a 20-year loan. However, every 5, 7, 10, or 15 years, you'll have to modify that loan for another term or pay it off or refinance it. Under the SBA 504, it's actually 2 loans. We have to partner with a bank partner, such as Anthony, and your term will be 10 to 25 years on a 20 to 25-year amortization. The SBA part of your loan, up to 40% of that loan, is fixed for 25 years. So really, your SBA part of the loan under a 504 looks much more like a residential loan because it's a fixed. It's a 25-year term with a 25-year amortization. The pricing, they're pretty much the same. The banks are going to offer a competitive rate, and the SBA rates are also very competitive. We all know right now rates are increasing. Right now, if we close today, an SBA 504 rate would be in the mid 5s. So no one really knows where rates are going to stop. The good thing with the SBA 504 rates is they are fixed and set once a month. So they don't fluctuate or change day to day. Of course, buying commercial real estate as a buyer, you will have to personally guarantee. So with commercial real estate, your business is actually the borrower, and you as the individual or owner is actually the guarantor, even though the business is also guaranteeing. Prepayment penalties, Most or a lot of commercial real estate loans, conventional, have those, but it really depends on the bank if they're going to offer that or not. The SBA 504 does have a prepayment penalty on the SBA part, but I always like to explain why that prepayment penalty is there is not to penalize the business for being successful when to pay it off early. It is because the 504 is funded as a bond. It's called a debenture, but it's not a direct loan from the SBA. It's actually sold on the bond market. So it sets a rate of return. And that prepayment penalty is not massive. It is actually equal to 1 year's worth of interest in year one. In year two, it goes down by 10% to be 90% of 1 year's interest, on down for year 10. So it's not a huge amount, but it is there. And I always like to let folks know that's there. On a resident, go ahead.
Yeah, Anthony, Grow Financial, just wanted to kind of jump in terms of the prepayment penalty. Grow Financial is a credit union, therefore we do not have a prepayment penalty for our loans. However, we do work in conjunction with the SBA 504, and just wanted to throw that out as well. So I'll let you take over from there, Dave.
Yeah, very well. Thanks, Anthony. And that's true. The prepayment penalty does vary by the lender. Every loan's going to have an origination fee. Typically in residential land, they're called points. In commercial, they're origination fees. And you can see those broken down there on those slides. Typically, it's anywhere from 0.5 point to 1.5 points of the total loan amount. Now, interestingly here with the SBA 504, that origination fee is only on the bank's part of the loan, was actually 50% of the loan. So it's a lower fee. Obviously, every commercial loan is going to look at credit scores. 650 tends to be the baseline. However, with SBA, because it is for economic development, we do look at all credit scores and all the mitigating factors. So if there's a good reason why, then we can help mitigate that. If someone has beat up credit because they just decided they didn't want to pay their loans, well, probably not so much help we can do. But if there's other factors involved, then we can certainly work with that. So I've kind of touched on some of these already, but the SBA 504 loan program, it is a partnership with your bank or credit union. It is a program designed to help businesses with long-term fixed rate financing to help you purchase commercial real estate, fixed assets, and those would be things like a parking lot and things of that nature, or heavy equipment. So we can't do truck financing or fleet financing, but we can do manufacturing equipment. I'm doing a loan right now for a landscaping company that is getting the landscaping equipment. So as long as it's all tied to the real estate, we can do it. The typical SBA 504 loan structure is 50-40-10. And what I mean by that is the bank does 50% of the loan. The SBA or Provident, a CDC, will provide up to 40% of the loan. And you as the business owner will put in starting at 10%. So on a typical $1 million structure, you can see the bank's at 500,000, SBA's at 400, and you're at 100,000. Now, if this was conventional, the bank would be at 800,000 and you would be at 20,000. So that would be the structure and the difference between a conventional and SBA 504. The 504 cannot be used for working capital, inventory purchases, or business acquisition. There are other SBA loan programs for that. That is the 7A. And I don't do 7As, and this is about commercial real estate, even though some institutions like to use the 7A for commercial real estate. Probably not the ideal product for that because it does have a variable rate. And as I said earlier, the SBA 504 is a loan program, is an economic development tool. And the whole idea behind this is job creation, helping you as the business owner grow your business. So the eligibility criteria for getting an SBA loan, your business must be for a for-profit business. So unfortunately, no nonprofits. And you have your services or goods have to be available to the general public. You've also got to be actively involved in running your business. So no absentee ownership. And cash flow is very important. And I'll talk about this, about the 5 C's of credit. But your debt service coverage or your cash flow is very important. And that ratio, which I'll talk about in a little bit, is 1.25. So the most important thing in commercial real estate lending is the business's cash flow. Acceptable credit history, both personal and business. And then all owners of the business also has to guarantee. So if you're 20% or more ownership, you have to guarantee the loan. And that also goes along with the conventional commercial real estate loan as well, unless the bank or credit union decides otherwise. You have to be located in the United States, and Provident, we lend anywhere in South Carolina. So this is the 5 C's of credit. Cash flow, credit, collateral, character, capacity. And you can see number 1 on that list is cash flow, because cash is king. And to lenders, that's the most important thing we look at. Bottom line is, does the business make enough money to purchase this real estate and then have enough left over after all their payments are made? And that's your debt service coverage ratio of 1.25 to 1.50, which in plain English basically is for every dollar of debt you've got going out, you're able to retain 0.25 up to 0.50. The higher that ratio, the much better your business is, the more money you're making and retaining. The lower that ratio, the less money you're making. You've got more money going out than you do coming in. Credit is very important. Obviously, your personal credit is a very good indicator on the performance, your payment performance on any of your loans. So we do look at personal credit and also your business credit if it has that established. Collateral, yep, your real estate will be the collateral that will secure the loan. Now, with an SBA 504, your personal residence is not part of the collateral. We don't take a lien on that. On conventional and other programs, that is potentially they can ask for that. So I just put that out there, but 504, we don't ask for that. And just so you know, if cash flow is very weak and someone wants to give more collateral, that really doesn't work, because the dirty little secret in lending, I like to say, is we take a lien on the collateral as security, but we don't want the collateral. We just want the loan to be repaid. So adding additional collateral to mitigate a cash flow weakness typically does not work. And then last, but certainly not least, is capacity. How well does your business operate? Can it operate during a downturn, which is, I think, very relevant right now into sort of the economic storm clouds we're seeing? Basically, can the business continue to service or pay their debt during a downturn? And if they can, well, then that's great, because they're probably going to do exceptionally well in good times. So what are the benefits of the 504 to you? As I said, basically it's up to 90% financing. So 10% down as opposed to the normal 20. Now there's a little asterisk there. And the reason being is, if you're a startup business, that is 2 years or less in business, then you add 5% to that 10% for a total of 15. If you're a special purpose property, and that is something that can only really be used for one use, then you add 5% to that 10% minimum down payment. If you're a startup and a special purpose, then it's 10% added to the 10% for a total of 20%. But it's all relative, because on a conventional commercial real estate loan, you're not going to get a startup special purpose property with 20% down. It's going to be 30 or more. Again, depend on the lender. The bank or credit union is at 50% loan to value, so they're more likely to do loans that they may not do because their risk has been lowered. The bank and or the credit union, the lender is in first lien position. The bank is in, the SBA is in second lien position on that property. The application process, it is streamlined, it's simplified. Everything that, say, Anthony will need, which he will discuss, is what I will need for SBA. I've got one other form that's unique to SBA, but by and large, any commercial real estate loan, any real estate loan's going to require paperwork, financials. And as I said earlier, your business is the borrower. So that's why it's very important we get the financials, understand the business, understand how you're making money. The other question is, well, for SBA, it's got to be owner occupied. The answer to that, yes. But for an existing structure, it only has to be 51% owner occupied, meaning 49% can be leased out, in income producing. So something to think about that there. If you're looking, as long as you occupy 51% of an existing structure, then we're good. If you're building something, then the owner occupied percentage goes up. There is a savings, as I said, with, say, like origination fees that can be put into the loan that you don't have to pay at closing, such as all your soft costs, appraisals, environmentals, which those are always needed with a commercial real estate loan. An environmental report is not something you get with residential, but for commercial, by and large, every commercial lender is going to require an environmental report. And of course, Provident, my job is to help you with all the paperwork and to help make the process easy for you. And again, I partner with all the banks and credit unions to help that make a reality. So I'm going to be quiet here. And do we want to take questions now, Carolyn, or do we want to wait, Paul?
Well, we do have some questions in the chat box if you would like.
Yeah, let's go ahead and take some questions, and I'll put my contact information up here if anyone needs that.
All righty. So one from Miss Key. Can the 504 be used for soft costs like the architecture and engineering drawings needed for development of a project?
Absolutely. And those are very expensive costs as well. So that actually goes towards your equity injection or down payment. So let's say you're spending $50,000 for an architect fee. That goes to, you're already basically putting your down payment to the project. It's critical that you keep all your invoices and all your proof of payment. So if you paid by check, copy of the check. But yes, all those can be taken care of. If you don't want to make that part of your equity injection, it could also be financed in the loan.
Thank you. So Catherine Torrey asked, how can you give a cash flow indicator when you are just starting? I do not have cash flow yet.
Right. Yeah. Great question for startups.
It would be financial projections, wouldn't it?
Exactly. That's what I was going to say. Because SBA's economic development, we're able to look at projections. And in that case, we get anywhere from 2 to 3 years projections. There is a very good worksheet that I believe SBDC has copies of that can help a business owner do those projections. And that also helps our bank partners as well as they're looking at the loan.
Thank you. So another question, what if there are multiple structures on the property? How does 51% factor in?
Okay, so if again, it sounds like there's a couple of different office buildings, let's say on one lot. If your business or operation is utilizing those, the total square footage of all those combined, as long as that totals up to 51%. If you're, let's say there's 3 buildings and you're only going to occupy one, but the other 2 you're going to lease out, as long as the total of all those together, your building is 51%, you're within owner occupied.
Perfect. So here is another one from Ms. Key. For the new developments, new building, what is the required percentage of owner occupancy?
Yes, so within the first 2 years, you're expected to occupy 60%. And then I believe it's within 2 years is to go up to 80% with the ultimate goal of occupying all the property. And that's for ground up construction. Okay, so not an existing structure. And if you're buying an existing structure and you're remodeling it, that's 51%. But if it's coming up out of the ground, then the minimum you're required to occupy at the beginning for the first 2 years is 60%.
So here's another one, and I believe I know the answer to this, but I will allow you to answer. How does the lender and SBA treat a situation where a 20% or greater co-borrower needs to exit the business or is expelled from the business? Do they become released from the obligations or the guarantor?
So we've got multiple owners, 20% more, both guarantors, one's exiting the business and or being asked to leave. Is that the question?
Yes.
Okay, yeah. We would have to do a loan modification. If they're exiting the business, then they're released from that, but it has to be a loan modification on both of those notes. So the SBA loan note and the bank, the third-party lender's loan note.
And the last question we have before we move on to Anthony's presentation is, if you are building a smaller new office building, 8,000 to 10,000 square feet, with a classroom, 2 conference rooms, a kitchen and a garden patio, does all of that count towards 51% owner occupied?
Yes.
All righty. So David, if you will discontinue sharing, I will start sharing the slides for Anthony.
All right, thank you. Good afternoon, of course. Again, my name is Anthony Weston. I'm the commercial loan officer for Grow Financial Federal Credit Union. Our headquarters are based out of Tampa, Florida. However, we do offer lending services here in the state of South Carolina. My portion is always the most fun and exciting portion. And if you'll move to the next slide, pretty much I'm going to talk to you about we've talked about the conventional versus 504, which David did a great job with that. I'll go to the next slide. This is probably the single most important piece when it comes to getting the process started. Credit package essentials. So business essentials. One of the things that a lot of business owners, they ask, of course, is the business application. We provide an application in addition to the SBA, my SBA partner, who is in this case is Provident. We're going to provide that application. We need you to fill it out as thoroughly as possible. The more information you provide to us, the better, the more we know about you as well as your business and anyone else that's a guarantor in the business. Second portion is, I always like to think of threes. So when you're asking, what do you need me to, what do I need to provide in terms of returns? I always say three complete business tax returns for 3 years. That includes personal tax returns if the company is a sole proprietorship. We also talk about the interim financial statements. Now we'll do up to 180 days. And that includes your balance sheet as well as your income statement, because it goes back to what David discussed earlier. We want to make sure that the business is cash flowing. So once you provide those business returns and income statements and balance sheets. That's the material and information that we need in order to at least get an idea of whether or not the business cash flows based off of the loan amount that you're interested in. There's also the personal essentials. Of course, we need 3 years of business tax returns, but we also need 3 years of personal tax returns. And that includes anyone that has 20% or more ownership in the business. That's vitally important for us to have. We also need verification of income. Just depends, and this is a little outside of what we normally talk about, but sometimes business owners have an outside source of income, so we want to also include that as well. We want to make the case, I always like to say, we want to make the case to our underwriting group why it is important for us to move forward with your transaction. The third thing is a completed personal financial statement. And of course, that just lists all of your assets, liabilities, and we want to have that so that we'll know what your obligations are, but also it gives us an idea of the strength of you as a guarantor. And of course, this is required for any owner or owners with 20% or more ownership. You can move to the next slide. So there are no key takeaways. In essence, the biggest key, for me, the biggest key takeaway is simply this. The information that you provide, whether it's your business returns, personal financial statement, all of those things are vitally important for us to move forward with your requests. Proper documentation streamlines the application process. So the faster you get it to us, the faster we can move forward with the application. Conventional financing offers competitive rates, and most loans require a 20% down payment, as David stated earlier. Commercial financing is available.
So Anthony, I think you might have frozen on us.
Looks like it might be my turn.
All right, Drew. Well, I'll put up Anthony's last slide in case anyone would like his contact information. So if you would like that contact information, and I do have a couple of questions in the chat box that I will pose to all of you. So this is, building a strip store from ground up will need to purchase land, clear land, build building, and purchase equipment. We'll rent out suites and have a retail, which will be the anchor store. Would this be something that would fall under one of the loan categories?
Depending on how much square footage the total project is and your anchor store may or may not qualify under SBA owner occupied guidelines, but it would most certainly qualify it would fall under a conventional loan program as well. You know, with any loan program, there is no cut and dry. There's always exceptions, and we look at every case, every project as an individual project and what the parameters are on that.
So, oh, I'm sorry, go ahead.
No, I was saying that was quite interesting.
Welcome back, Anthony.
Yes, must be earlier. Hopefully that's the only interruption we'll get from the storm. I apologize for that. Just all of a sudden, laptop just decided to have a moment. So I think David probably picked up where I left off. Is that correct?
Yes.
Okay.
And we just answered one question, and then there's another question to both Provident and Grow Financial. And I know as far as SBA, the answer to this is no, but do you lend to non-citizens?
We do not at this time.
So in the process of having the green card, therefore do not have it yet. So once the green card is obtained, would that be possible?
Yes, that is possible.
Yes, and that's the same with SBA. As long as you're a legal resident and you have authorized paperwork, i.e. the green card, then you do qualify for SBA. But that's it. Real life example, I did have someone reach out to me one time who wanted to get a loan. They were on a student visa. Student visas don't qualify. They're designed to expire, and the student is expected to leave the country at the end of their visa. So either a U.S. citizen or a permanent resident.
Alrighty, so Drew, I will move on to yours if you're ready, sir.
Sure.
There you go, sir.
Okay. Thank you, Carolyn. Thanks for having me today. My name is Drew Shofity. I'm with Palmetto Commercial Properties. I've been a commercial real estate broker for about 25 years. Around 5 of that's been in Charleston. I came from North Carolina. So I've been doing this a long time, seen a lot of different things. Next slide, please. Okay, I'm going to try to keep this fairly brief today. There are a million different ways to handle each of these situations, but I've tried to just kind of generalize some things, and we'll just cover some stuff real quick. And if you have questions, ask them. You can always contact me later if you want to get it more in depth with these things. So some topics for today that I thought we would talk about: working with a commercial real estate broker, finding a commercial property, and then making and negotiating an offer. Next slide, please. Okay, working with a commercial real estate broker. One of the things you need to consider is their reputation, not just the broker, but possibly their firm. So there are a couple different ways to do that. Obviously, these days, everybody goes online, whether you check out their LinkedIn page, their other, I don't know about their social media unless it's professional. But the same thing with the firm. Go to the website, make sure you're familiar with them. You also might ask the broker for some referrals. They may give you some phone numbers or some people that they have dealt with in the past that you could call and find out how the experience was. You also could actually talk with members of your own network. Different business types have different gatherings, and maybe someone in that network has worked with a broker before that they trust. The other thing when working with a commercial real estate broker you want to do is find out what kind of experience they have. Have they been in the area for a long time? Do they know the different property types? What exactly types of deals have they done? And so experience, a lot of times people think seasoned, you've been in it a long time, but typically that's not a bad thing in real estate. However, a new broker, someone that's young, probably has some advantages. Oftentimes they're hungrier. They're probably better on the web than I am, unfortunately, mining data. And if it's something fairly simple, like you want to, whether it's leasing or buying, but say you want to buy a small building that's fairly straightforward, there's no problem having someone that's fairly new, as long as they know the process. If it's something more complex, like one of the questions earlier about development, you probably don't want someone new in the business advising you on developing a property. It's a little too complicated. The last thing is industry knowledge. So you want to have somebody that knows the different submarkets in Charleston. Obviously, we have a bunch that are fairly defined: the Peninsula, James Island, North Charleston, Daniel Island. You want to make sure that they know not just what's hot today, but if you're buying something, you want to know what's going to be in a good area 5 years from now, 10 years from now. Where's growth going? In Charleston, another example, that's maybe the neck area out of the peninsula. A few years ago, it was just, dirty land and by the ports. Today, there's all kinds of stuff popping up there. And so you really want to make sure you have somebody that's in tune with the market. Okay, next slide, please. So finding a commercial property, there is no one way to go about this. I have different ways, and certainly all of you would. So one of the things when you identify finding a property, you want to possibly identify multiple locations. Oftentimes someone might drive by a building on the way home from work and think that's the building for me, and that's fine. But in the future, if you're the business owner, you might not, it's not possibly just going to be you or you and someone else. You might have multiple employees. And so do you want to locate somewhere where you live, where your employees live? I know in Charleston, it's easy to get stuck in traffic. So would it be possible to have something a little closer to where you live? That's something to think about in retaining employees. Another thing is multiple locations. This is in the beginning for zoning. So a broker can help you if you can't figure it out, engage in where is your business allowed to operate? And that's a zoning question. Well, it's not just as easy as pulling up the zoning for a property, which most people typically do. There's also under zoning the allowed uses. And so I had a property, it was a doggy daycare on James Island. It was under contract, getting near the end, and it was allowed under the zoning. However, the use wasn't specifically allowed because the building, I think we needed 50 parking places, which seems absurd because doggy daycares, people drop them off and leave. They don't stay there and play with them all day. But we didn't know that at first. And although we asked them to verify that, until the very end. So don't just stop at zonings, go to use. And another thing with multiple locations, a lot of times you might make an offer, but it's not going through. So you might want to have a couple different areas to consider. So the second thing in finding a property, you want to make sure you budget property. David and Anthony already told you some of the things that might be included in whether it's an architect, other types of fees that you need to know. You want to make sure that you have cash on hand to possibly pay stuff up front before the loan kicks in. So don't just think of it as getting the loan. The last thing when you find a property is the size of the property. You want to think about it now, but not just now, later. If you're in a high growth business, you probably if you can measure your growth, that's one thing, but sometimes growth explodes. And if you've bought a building, it's not that liquid. I mean, you can buy and sell them, but you can't do that tomorrow. So in the early stages, once you're established, buying is great. That's what we're here today for. Sometimes leasing is an option because if you think you're going to grow fast and you signed a 3-year lease, well, then you can go and just get a new space as opposed to trying to sell your building, re-upfit it, and do all those types of things. So the last thing is making and negotiating an offer. CCIM, which is Certified Commercial Investment Member, that's what I am. That's a international commercial real estate organization that teaches master's level classes in commercial real estate. Well, we have a class, it's an 8-hour class on negotiating real estate. So obviously I'm not going to cover everything in 45 seconds. So this can get complicated if you want to. So you want to know the comps in the area. You want to know what's going for your property type, what kind of comparables are there. Obviously, everyone knows the last few years prices have skyrocketed in everything, commercial and residential. And so it's probably a good idea to know a couple of years in the past, but you also kind of want to know where things are going in the future. Is this a hot market today that's going to keep appreciating? And with interest rates up today, the hot markets may not be what we thought they were, 12 months ago. when you make and negotiate an offer, a lot of these points are not specifically on how do you negotiate. You know, do you go offer low and counter and that kind of stuff? That it's a little too complicated. So this is things to think about when you're ready to make your offer. You want to understand the all-in cost. It's not just the cost of the property itself, but especially for small business owners, you're bearing all of these things. So if you're going to move or buy a building, there are moving costs. You typically pay movers. There's signage on the building. I'm working with a client in North Carolina right now who it's a retail use, and those backlit letters that light up at night called channel letters, he thinks his sign is going to be $25,000. Those things are not cheap. You're going to have marketing costs. You're going to change your business cards, all your branding, your koozies that you give out at after hours things. You know, everything needs to be updated. So don't just think about the real estate. You need other things as well. And prepare for possible delays. This is once you, while you're making the offer, there'll be a due diligence period or an inspection period. It's a little different for commercial than it is for residential. Commercial, in the South Carolina contract, you can get your earnest money or deposit back for any reason up until the last day of due diligence. Sometimes it's about 60 days if you're developing something and you have to rezone it. Sometimes those due diligence periods are 6 months or even a year on a big shopping center project. So just understand it's always going to take a little longer than you think. And Anthony and David covered a little bit, but there could be possible financing delays, especially now with rates going up. I worked with David early on when I was here, and a business that should have qualified, she was bringing him information in shoe boxes, like just shoe boxes of receipts. That's not the best way to get a loan. If you have all of your records in order and ready to present the package, then David or Anthony can probably give you a pretty good idea how much you can borrow. And then we begin to look for the property. So it goes hand in hand with knowing how much you can borrow with really what type of property you can buy. So I don't have my contact information at the end. I had it at the beginning. Happy to talk with anybody. We'll go out and get some coffee if you just have some ideas, or welcome to ask some questions here as well. So thank you.
Hey, I've got a question, Drew, and maybe it's not a question, but I do have a question for you and Anthony. But first, I just want to kind of point out to everyone the importance of using a dedicated commercial real estate agent or a real estate broker, not a residential, unless, of course, if they've got CCIM, but the CCIM designation is for commercial real estate brokers. That can cause a lot of problems because of the unique differences between residential and commercial. Real life example, I did have a borrower that used a friend who was residential and also did commercial. Got to the closing table, turns out she was ended up buying a property that was not zoned for commercial. It was zoned residential. She had to go to the town to get it rezoned. That took close to 8 months. She was making a mortgage payment and not operating her business for 8 months. So it can be a costly mistake. And I don't know if anything you want to add to that, Drew, but I think it's critical that you use a dedicated commercial real estate broker and not a residential real estate agent.
Right, absolutely. And that typically happens. Someone may have a friend and they think they know what they're doing, but they don't. The National Association of Realtors basically says commercial brokers do commercial, residential brokers do residential. Now, the exception to that is in some rural markets, there's just not enough commercial or residential. So actually, those people usually are called resi-mercial agents. But that's usually in more rural areas. You're not typically going to find that, in Charleston or in some of the bigger cities. Every once in a while, someone may help their in-laws buy a house, but they're usually not going to list a house as a commercial agent. But there are too many differences to just have your buddy help you. Good
Okay.
question, David.
Yeah. So question here for Drew and Anthony. As a someone looking to buy, what do you recommend, or what's your advice? Do they go under contract to purchase and then apply for a loan, or should they apply for the loan and then go under contract? What's the preference? What's ideal?
I would say probably, not knowing the exact process for everybody, it's a little bit of both. So maybe you talk with your advisor, your banker, David, and maybe you could ballpark what you think your buying power is. And usually people know, but quite often, if you're confident you think you can buy it, you will typically go look for it, put it under contract, be talking to your banker as you're looking at the properties, if you really think you're going to wind up buying one. And then once you put it under contract, you have everything ready to deliver to them so they can go ahead and do the underwriting on the project. You don't simply start thinking about how you're going to finance it once it's under contract. You kind of need to have gotten to that point, but you don't necessarily need to. Sometimes, especially in the late housing market that's been so competitive, people, bring their commitment letter with them. You don't usually have that in commercial, but you need to have a good idea if you're going to qualify or not.
Yeah, I would agree with Drew in that regard. It's a hand-in-hand situation. Typically, to his point, we can, based off of the information that's provided to us, get a ballpark in terms of cash flow. What does that cash flow equate to? How much purchasing power do they have? And if so, everything, of course, I always like to say when we get to underwriting and we get a full financial package, there are some things that as a loan officer, I may not be aware of. But if you give me enough financial information up front, we can almost get an idea of, how much purchasing power you have. So it is something that, to Drew's point again, kind of goes tandem, it's hand in hand. You want to already be in the process of speaking to the lender, but you also want to have an idea of what you're looking at. And based off the information you provide and get a full financial package, we can move forward as far as the application process is concerned.
Gentlemen, we have a few questions. This one is for you, Drew. Can you mention some of those delays that are common? I know that you mentioned zoning, and then there's construction delays, but any other common delays that you're familiar with?
Always permitting. Now, oftentimes you're not permitting until after you buy the property, but especially in Charleston, things you might think it takes 30 days and it takes 6 months. Other things delaying. People get frustrated in commercial real estate, our clients oftentimes, because stuff doesn't happen immediately. When they're ready to go, the client's ready to go, they're ready to go. But there are oftentimes multiple people involved in the process, whether it's summertime or Christmas time. In our business, once it gets to be November, you're basically, people leave. So you have attorneys in the chain. Sometimes you have engineers, sometimes you have architects, and each of those often work on their own schedules, and they've been very busy lately. So those types of delays are very common. So you need to kind of think about that when you do a due diligence period, because that stuff, usually it's 60 or 90 days, but just be prepared to ask for an extension.
So these questions come from Robert, who is one of our consultants here. How long does it normally take to apply for a commercial real estate loan? And how long does it typically take to close?
Well, applying and closing, I mean, I always say the application process really is driven by the borrower. So as lenders, Anthony and I say, we need 2-3 years tax returns. current balance sheet and P&L or income statement, and you wait a week or 2 weeks to get that to us, we can't start underwriting for a week to 2 weeks. So it's ideal to get all the information requested to us sooner rather than later, because as soon as we have a complete package, we can put it into the underwriting queue, because underwriters don't want to work on an incomplete financial package. If they start coming up with a bunch more questions, they'll just put it aside until they get the rest of the information. So really that process and timeline is driven by the borrower. But let's say we've got everything in, and Anthony, you could add to this, but I would say typical underwriting for a normal business that is not super complex with an LLC, owning an LLC, owning an LLC type situation, but just one owner, one property. We're looking at about 2, maybe 3 weeks underwriting turnaround time. Really depends. I mean, right now, Anthony's underwriting team, they're in Tampa. Well, they're probably real distracted right now from underwriting. So that now to close, and as what Drew said about delays and timelines, we can essentially get closed within, I would say, 60 days. I always recommend, if you're going under contract, at least try to get 90 days and negotiate for some possible extensions, just because if something should come up to delay the process, you've got some padding built in. So overall, I would say from application process to getting a loan approval, we're looking at 6 weeks, maybe a little more. And then closing, that's when all the attorneys do their work and the loan processors, and that could be another week to 2 weeks. So really 6 to 8 weeks.
Yeah, one of the variables that we've experienced, particularly up until probably the last 30 days or so, it's just been appraisal times. Appraisal companies have been, specifically in this area, they've been pretty busy. So appraisal turnarounds, they can be as little as 2 weeks, and I've seen some come in 3.5 to 4 weeks. Just depends on the process. I know for Grow Financial, we do bids. So if you're interested in, let's say we get you approved, we move through the process as far as approval, we submit bids. So we just basically we throw a bunch of bids out there. I have no idea who the bids are. They come back. They can range anywhere. I've seen them range from 2 weeks, like I said, to 4 weeks. That's something that is a variable that you have to budget. So typically when I'm in this particular market, I'm saying be prepared for 3.5 to maybe possibly 4 weeks. But sometimes it could be 2 weeks. Just depends on what's happening in the market. Dictates appraisals. That's always been one of the variables that when I'm working with a buyer, that's the one thing I express the most. Once we get to appraisal bids, we can see anywhere the window can be pretty wide. So
surveyors as well.
Sir?
Surveyors as well.
Surveyors, yes. A lot of properties, we require surveys. Depending on when that property was built, finding surveys, and those things can be challenging. Those are some of the things that that come up. So to David's point, I always say conservatively 60 to 90 days. And that's, you get us a full financial package on time, we get it underwriting, the appraisal goes well, all of the back office due diligence items are taken care of. Hey, we can turn them around, but you always got to be anticipating that, hey, this thing could string out for 90 days.
And the sellers don't want to hear that.
Yes, that's true.
That's one of the hard parts.
Right.
Oftentimes when you make an offer, I'll tell a client, if you have a shorter due diligence, they'll probably accept a lower price. They're probably going to be a little tougher on you because they don't want to tie the property up for 90 days. Right. If you then can't qualify. So they always want a shorter amount of due diligence time.
So the lesson there is be prepared. Get your financials together, know what we know, talk to us. And the other thing from the SBA perspective is keep in mind SBA's economic development. They want to know who the borrower is, and they will really want to understand your business. And keep in mind, underwriters that come to all this information brand new. You know, I mean, they're the first time they're seeing your business. No one knows your business better than you. So we oftentimes ask borrowers to help us, give us some flavor and tell us about your business. Share the information with us, help us understand so we can keep the process and the momentum moving forward.
So we have one last question before I ask this or pose it to you, gentlemen. I want to remind everyone that we will be sending out a post-event survey. And in fact, Robert may have already sent it out. So if you could please answer that. And those individuals that answer will be receiving a copy of all of the slide presentations, as well as a link to the recording. It may take us 5 to 7 working days to get this out to you, but rest assured that those that answer the survey will receive not only the slides, but the link to the recording. So the last question is, what's an average personal credit score that banks and lenders want to see?
650.
650.
That was a quick one.
Yeah, it is. You know, the stronger the credit score, the better. Now, again, from the SBA perspective, if you've got a lower credit score, but some mitigating factors and some good reasons why, you know, that helps as well. But I would strive to work for a 650 or a greater credit score.
I concur with that.
And Paul, if you would like to share with the audience how we can assist in this process and close the meeting for us, that would be wonderful.
All right, let me get unmuted here and I will start my video. Well, great. Well, thank you very much, guys. That was fantastic. There was a lot of really great information there. And I want to say, and I mentioned this a little bit when we were starting, but just to kind of reiterate that, you know, we can assist with this process. All these things that they've talked about that is information that you need for these applications and things that you want to think about and work on and consider as you're getting ready to do this. These are all things that we can help you with as you go through this process. You know, you don't need to go through it alone. You know, certainly, you know, your lenders are here to help you, but we as SBDC are here to help you as well. This is what we do. And so we can help you through that process. But I appreciate everyone's time today. I appreciate everyone joining us. I thank you to our speakers. I appreciate it. It was a really great presentation. And I hope everyone stays dry and stays safe through the storm as we go through the next few days. And again, thank you for your attendance.